They've already said, 50 in June, 50 in July.
From our perspective, the markets are performing incredibly well. There's a ton of liquidity in the market.
It's possible we go into recession, obviously. Probably 50-50 odds now, but that's okay.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 14th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Stocks rebound in Europe along with U.S. equity futures as a sell-off takes a breather. Markets await the next data point. PPI drops at 1:30 UK time. The 100 basis point question. Now markets start pricing in even more dramatic hikes by the Fed. JP Morgan sees 75 basis points, but describes a full point hike as an untrivial risk. And dip buyers rush back into crypto. Bitcoin pairs a plunge of 10%, but still trades lower than at any point since December 2020. So let's get straight to the markets. Yesterday's market moves were so extreme that for some traders, it actually evoked memories of the Lehman Brothers blow-up. Now, first, Asian stocks market sold off, but that negativity really rolled on around the world, sending the S&P 500 into a bear market and wiping $1.3 trillion off equities. Now, other risk assets sold off, with cryptocurrencies, for example, plummeting so violently that a popular lending platform froze withdrawals to prevent a very modern kind of bank run. Meanwhile, the dollar index roared to the highest level in almost 2 decades. Now, short-dated U.S. yields jumped by so much that the 2-10 spreads, of course, the curve inverted for the second time this year. The last time yields moved so fast in 2 days was back in 2008. And here's how some of the guests on Bloomberg TV reacted to that sell-off.
This week is fraught with peril.
Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
because I still think we've got some wood to chop with respect to the macro and policy outlook.
Well, joining us now to break down the action is our EMEA equities editor, Ksenia Galuchko. Ksenia, yesterday was really a crazy day. What are markets now pricing in?
Well, yesterday was totally crazy with the S&P 500 finally closing in a bear market. And then today we were expecting a rebound, but it has been very fragile. So European markets opened higher. We were expecting finally the recovery to start, but it did not last, which just shows you that the caution is out there. Everyone is looking forward to the Fed, and that is the big surprise of this week. Are they going to go with a 75 basis point hike, or there's strategists floating the idea of 100 basis points? That will be a real shocker.
So the problem is that also it hurts their credibility on why they haven't acted earlier and seen this right. But Ksenia, no recession at the moment is priced in, so we could fall even further.
That's right. Yeah, earnings have held up pretty well. I was looking at the Citi Earnings Revisions Index just this morning, and it's showing rising earnings expectations in Europe and a slight drop in the U.S. and global profit expectations. So analysts have yet to catch up with this doom and gloom in the market. We have the Bank of America monthly fund managers survey out today, and it's showing that actually among fund managers and investors, the global profit expectations are at a 2008 low, and that is pretty significant. So there's this discrepancy between analysts and investors out there.
Ksenia, overall, I guess commodities kind of held up okay, which points to possibly no recession. But then we have this huge fragmentation debate, and Italian yields really moving.
Absolutely. And commodities are actually a very interesting story because yesterday they were truly a haven out there. And commodities are moving on very different factors. It's not the Fed that's moving them. It's obviously the war in Ukraine. It's the supply crunch issues, right, around Russia. So it's a very different story. Actually, what's interesting in the Bank of America Fund Manager Survey on commodities today is that it's one of the longest positions among investor portfolios. So investors are very bullish commodities at the moment and mining and energy stocks. So they remain positioned in that department.
Ksenia, thanks so much. Our EMEA equities editor there, Ksenia Galuchko, with the very latest on the markets. Now, in the midst of the market action, traders also boosted bets of a more aggressive path for Fed rate hikes. A 75 basis point increase this week is now being priced in by markets with a terminal rate of 4% by May 2023. Now, economists at major Wall Street firms were quick to change their calls. Goldman Sachs and Nomura both shifted on Monday to forecast 75 basis point hikes this week and at the Fed's meeting in late July. Well, JP Morgan also went to 75 basis points at this week's meeting, joining Barclays and Jefferies, who modified their calls Friday to the biggest increase. But even 75 basis points isn't large enough for some, with mounting talk of an even bigger rate increase.
They've already said, 50 in June, 50 in July. Given how bad the announcement was Friday, I think what Chairman Powell can do is bring that 50 forward. Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
Well, we're joined by Paul Donovan, UBS Global Chief Economist. Paul, great to speak to you right now. I mean, last time you were around, you were kind of saying there's inflation, but we're seeing also signs it's subdued.
Yep.
Have you now changed your mind?
No, I mean, if you look at the detail of what we got on Friday, and remember, of course, CPI is not the Fed's target measure for inflation. About a quarter of the index is in disinflation or outright deflation. You've got falling prices in the detail. Now, what's happening, of course, is that the bits of inflation the Fed can control, you're seeing disinflation and deflation. The bits of the inflation the Fed can't control, you've got strong inflation. So you've got this balance. And the question is, how much deflation is the Fed going to cause in the areas it can control to offset the bits it can't control?
But so it needs to hike rates quite aggressively, right? So is 75 basis points now a done deal?
No, so I think the biggest inflation threat we face at the moment is pundits inflating their Fed forecasts and competing frantically to get up with the highest possible number. The Fed is looking at a measure it doesn't particularly rely on. It is saying, well, it was a bit higher than expected, but actually we've got a mixed picture. And I think it's going to be fairly sensible in its approach. So 75, I don't think is a done deal. It's possible, but I don't think it's a done deal.
But is there now runaway inflation? And what's changed in the last 6 weeks?
So nothing has changed in the last 6 weeks. I mean, this is the key thing, that when we look at the inflation picture, we are seeing where demand is weakening, prices are slowing or outright falling. So you're actually seeing that happen. We're not seeing out-of-control wage price pressures. So the wage cost price spiral just doesn't exist. This is why you've got negative real incomes, which is unfortunate. We're running out of cushions for certain groups. So lower-income Americans have spent their savings. They're now forced to borrow on credit card for day-to-day living expenses. That's not a sign of something which is going to sustain. And again, it's a disinflation force in the economy.
Okay, is this like a nightmare scenario that we're dealing with because the Fed didn't see it coming?
Well, I think the problem for the Fed, of course, is that most of what they saw coming, the transitory inflation, that happened. The transitory bits of inflation have proved to be transitory. What they've then had is this commodity shock, which is a combination of Ukraine and climate, because it's a La Nina year and we know that always pushes up food prices. So that's created a real problem for them, which was, frankly, impossible to forecast.
Was it, though?
Well, I mean, the La Nina effect is always difficult to how big an effect do you have in terms of pricing. Once you've had the war in Ukraine, the problem there was not so much the oil price, of course, but the refinery capacity and the refined oil price, and that's been quite difficult to get a handle on. We've also got a lot of complications in terms of shifting demand patterns. So consumers aren't behaving the way they normally do. We've seen more dramatic cuts in driving, but people being a lot more resilient about, no, we absolutely are going on holiday regardless of airfares.
I know. All I know, Paul, is that like 5 people actually asked me whether their mortgage rate will go up, and these are people in good jobs because they're worried because they're over-leveraged. And inflation is also going, their energy costs of living are going up.
So, I mean, there are constraints coming through. And so certainly, absolutely, in countries like the UK, where rates are sort of semi-variable, that is a concern for people. If you've got a variable rate mortgage, the cost of mortgage is going up. In the US, of course, the overwhelming majority are on fixed-rate mortgages. And this is, of course, one of the quirks that, according to CPI, the cost of owning a home has been rising, when, of course, it's collapsed in the last 2 years. And so that does give a sort of a bulwark against a recession risk
Yeah.
because you've got more spending firepower for middle-income, home-owning consumers than the headline inflation number suggests.
So we have traders coming on saying this reminds me of 2008. It's not something that you see.
Economically, this is nothing like 2008. I mean,
Any parallels?
Not really. I mean, the problem in 2008 was you've got balance sheets which are extraordinarily stretched, and households had been, leveraging themselves up. And of course, we've got quite the reverse this time. We've got stockpiles of savings. Now, as I said, lower income households are now starting to borrow on credit card. That's not a problem now.
Yep.
The trend could be problematic, and that might start to echo 2008 parallels. But again, for the higher income households, the top 50% of households in the States, they've got a stockpile of cash, they've got more savings than they've ever had before, and they are, to a certain extent, sort of insured against some of the problems we saw 15, 16 years ago.
So where do you see the Fed interest rate actually going in the U.S.? Does it, go much higher, maybe 5%, and then come down as they start cutting in 2024?
So, no, I think 5% is too far, because we've got a situation where either we're going to have very high inflation, in which case 5% isn't going to do it, or more likely, we're going to get an abrupt drop in inflation coming through. Because, I mean, if you look at what's happening with wages and so forth, the inflation is not being driven by labour costs, it's being driven by profit margins. You cannot continue this indefinitely. That at some point the consumer is going to say, actually, we're just not spending. And look at what Target was saying with their results in the second quarter. They're basically saying consumers are cutting back, we've got excess inventory, and we are now going to have to go on a price discounting splurge to try and get rid of this excess inventory. That, on an economy-wide scale, is, I think, the more likely scenario, and that stops a 5% number.
All right, Paul, thank you so much. We'll talk also about the UK next. Paul Donovan, UBS Global Chief Economist, stays with us. Now, coming up, 50-50, Morgan Stanley's James Gorman says there's an even chance of a recession in the US. More on markets and the economy next. This is Bloomberg.
We're unlikely at this stage to go into a deep or long recession. It's possible we go into a recession, obviously. Probably 50-50 odds now. But that's okay.
Well, that was the Morgan Stanley Chief Executive Officer, James Gorman, saying he sees a 50% risk of a U.S. recession. Still with us is Paul Donovan, UBS Global Chief Economist. Paul, what are the chances of a U.S. recession right now?
Well, I mean, if we're talking about a prolonged period of negative economic growth, I mean, it's inevitable at some point. You always get a period of below-trend economic growth at some point. This year, I think we've got quite a lot of cushions. I mean, remember, the middle-income consumer with their stockpile of savings, corporate balance sheets are okay. There's job security, so you're not getting real wage growth, but you've got job security. And that's quite important because it's when people are nervous about their jobs that they really change their spending behaviour. Ultimately, the US economy is all about the consumer, and they are there to provide support.
So what do you do with the inverted yield curve?
Well, the inverted yield curve is never a great predictor of recessions, particularly in the current environment. It just doesn't really work because you're manipulating bond markets. I mean, the UK gilt curve has been inverted for most of my career. The UK has not been in recession for the last 3 decades. It's not a great indicator overall.
I have a million questions. One from Valerie, our queen of charts, basically saying, why would the Fed upset markets and not hike 75 basis points, given it's priced in?
Because the market, I think, has only suddenly come to this conclusion. And the Fed is here to run Main Street, not Wall Street. That's ultimately its goal. I think it could, as I said, raise 75. But I think that they're going to want to give a fairly measured signal about their tightening. The market has sort of fed on itself in the last 48 hours. 48 hours ago, the market wasn't here. The market was perfectly happy with 50 basis points. We get one number the Fed doesn't monitor going up, and all of a sudden the market is feeding on its own panic. And as I said, this I need to be the highest forecast in the street. This competitive race to forecast the Fed up. that's not necessarily going to influence economists at the Fed,
You've just
I think.
destroyed like all of your competitors, accusing them of clickbait, right?
Well, you know, we're all guilty of clickbait, but please follow me, _Donovan_ on Twitter. But I think that there is a sense of panic here where the Fed is taking a step back and looking at things a little bit more rationally because it is dealing with Main Street. It's going to be looking at what we've had from the Beige Book. And of course, a lot of members of the Fed are going to have gone into this meeting, with their minds pretty much made up on the basis of the evidence of the last month, not the evidence of the last 48 hours.
Okay, I have two quick questions. First of all, Italian yields. Will the ECB have to come up with a flat plan to convince the markets that they won't allow fragmentation?
I think they do need to come up with a plan to avoid give them some time. As always, the ECB is late. I mean, they're never on time with anything. Everything in Europe is always done at 5 minutes to midnight, or actually generally 5 minutes after midnight. I mean, it's always very, very last minute. But yes, obviously, they need to reiterate the integrity of the euro, etc. But I mean, do remember, the Italian government has an awful lot of experience at selling debt. So I wouldn't necessarily panic about Italian yields at this stage.
Yeah, I keep on hearing that from Rome. It's the Draghi effect. Very quickly on Brexit, and of course, these UK real wages posting their biggest drop in 2 decades. Will cable ever trade above pre-Brexit level of 1.45 again?
Absolutely, it will at some point, obviously. At the moment, the UK is in a different cyclical position to other countries. We've got the biggest tax grab in almost 70 years from the Johnson government. That's having a depressing effect on the economy. The real wage effect, bear in mind the bonus payments. Bonuses are being used to sort of top things up a little bit. It's not quite as bad as wages alone would suggest.
But 1.45 at some point...
Well, not this year, probably not next year. But the UK economy, does have underlying resilience. There is competitiveness. It's a longer-term view.
All right, Paul. As always, thank you so much, Paul Donovan, there, UBS Global Chief Economist. Now let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. The UK has unveiled legislation to override parts of its Brexit deal with the European Union. The move risks a trade war with the EU, which has threatened to take legal action. If passed, the bill would give the UK the power to unilaterally rewrite the bulk of the Northern Ireland Protocol, which kept the region in the EU single market after Brexit. Hong Kong's lobby group for fund managers is urging incoming Chief Executive John Lee to scrap quarantine rules for travelers. The Hong Kong Investment Funds Association says the city needs to restore its status as an international financial center. The body represents firms with more than $52 trillion in assets under management. And emergency crews from California to New Mexico have been battling wildfires that have forced hundreds of people to leave their homes. The fires, such as this one in Arizona, have been driven by high winds that have grounded aircraft that would have been used to fight the blazes. The number of square miles burned so far this year is more than double the 10-year U.S. national average. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Angel, thank you so much. Angel Feliciano in London. Now, coming up, but despite the tightest labor market in living memory, high inflation in the UK is reducing the spending power of households. We discuss what this could mean for the Bank of England next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK cost of living squeeze is intensifying, with the spending power of households falling by the most in at least 21 years. Now, this backdrop, of course, created a major challenge for the BOE as they tried to curb inflation without pushing the economy into a recession. Now, for more on this, we're joined by Bloomberg's EMEA economics and government correspondent, Lizzie Burden. Lizzie, so what does this exactly mean for the Bank of England? This is like a tough environment for households, but it's also a tough environment for companies that have to pay wages more.
Exactly. So you've got something for the hawks and the doves in this data, because on the one hand, it underscores the pain of the cost of living crisis because inflation is swallowing up real wage growth. But on the other hand, it shows how tight the labour market is, but that it's easing. So unemployment rate unexpectedly rose, but that was driven by the rise in the drop in economic inactivity. So our economists think that this doesn't doesn't change the calculus for the Bank of England on Thursday. They still see 25 basis points, and that would take the key rate to 1.25%.
I mean, what are we expecting UK consumers to do? Because if your real wage, I mean, you have to spend less at some, in certain items.
Yeah, well, you've got low consumer confidence in the UK, but interestingly, in the GDP figures yesterday, you didn't see that translating into a hit to demand because you still saw people going out shopping, and so that hasn't happened yet, but it's not to say that it won't happen down the line.
All right, Lizzie, thanks so much. Lizzie Burden there with the very latest on the UK data. Now, stocks in Europe are pretty much steady. If you look at US futures, also steady, certainly more stable than they were yesterday, where we had this crazy volatile day. They rebounded after a market rout driven by expectations of sharper Federal Reserve interest rate hikes to fight inflation. I'm looking, for example, at the Stocks Europe 600. Now, they're now unchanged, so they did pair an earlier gain to hover at around a one-year low. Banks outperformed HSBC, for example, climbing some 3% amid speculation that it may spin off its Asian unit. And then the one thing we need to watch out for is also Italian yields. The 10-year above 4%. When does the ECB, if the ECB steps in to show the markets what tools it has to deal with fragmentation? Coming up later this morning, we'll speak exclusively to the Hong Kong Chief Executive, Kailey Leinz. That's an interview you don't want to miss. This is Bloomberg. Stocks rebound in Europe along with U.S. equity futures as the sell-off takes a breather. Markets await the next data point. PPI drops at 1:30 UK time. The 100 basis point question: will markets start pricing in even more dramatic hikes by the Fed? JP Morgan sees a 75 basis points, but describes a full point hike as a non-trivial risk. And dip buyers rush back into crypto. Bitcoin pairs a plunge of 10%, but still trades lower than at any point since December 2020. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, all but 5 stocks in the S&P 500 tumbled yesterday. The benchmark posted a more than 20% loss since its January peak, crossing it into a bear market. Asian stocks extended the sell-off this morning as investors continued to process the possibility of a more rapid Fed tightening. Now, it's been enough for some to resurface scary memories of the global financial crisis more than a decade ago. Here are some of the reactions from our guests to the broad market sell-off.
This week is fraught with peril.
Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
because I still think we've got some wood to chop with respect to the macro and policy outlook.
Now, more on the markets with Christian Muller-Gleesman. He's Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation, and he joins us now. Christian, always great to speak to you. Thanks so much for coming on. I don't know how many traders were hiding under their desk yesterday, but I'm sure a large part, of course, suffered some huge losses because of this huge repricing. What happens to markets from now?
Yeah, listen, I think you heard it in the comments earlier. There was a hope that we are getting closer to peak inflation, but I think inflation risk is still dominating. And inflation risk matters from 2 perspectives for markets right now. On the one hand, we are kind of reversing a valuation equilibrium we built over the last 20 years, where this low inflation has allowed equities to trade at higher multiples, especially longer duration equities. So that's coming a bit out of the market. But at the same time, the monetary policy tightening process, which is accelerating now, and our economists are expecting a 75 basis point hike at the meeting, and I think the market has shifted to that very quickly. I think that also triggers recession risk. So markets have to deal with both of those issues. And that also means that multi-asset portfolios like 60-40, these type of balanced portfolios, they're kind of feeling it on both sides, no? And you have like big drawdowns.
Yes, Christian, actually, we were speaking to BlackRock's Scott Thiel a bit earlier on, and he said there has not been a worse time to engage in that 60-40 portfolio. Let's have a listen to what he said.
It's also the worst year for a 60-40 or 50-50 portfolio of all, in the last 30 years. And so that obviously is going to move people into a more defensive position.
So do you agree with that, Christian?
Well, you know it. I mean, we've written a research note called The Balanced Bear end of last year, where we kind of made exactly that point, that these portfolios are carrying much more risk when there is inflation. Bonds cannot buffer equities, and there are these negative feedback loops from bonds to equities, where I always say, like, in the last 20 years, it was primarily growth volatility that drove rates volatility, whereas this reaction chain is now reversed. Now rates volatility is driving growth volatility. So to fix that problem, what we've been advocating is that you focus on more short duration assets, both within asset classes, but also across assets. And you focus more on real asset allocations, like infrastructure, commodities, real estate, gold, and anything that kind of can protect you from this high inflation.
Christian, how would you describe yesterday? I know there was this market rout. We've been speaking to traders all day, and they were saying, some parts of the market, certainly the bond rout, what we saw, for example, in crypto going haywire, in terms of market function, held up, but a lot of the moves reminded them of what happened in 2008.
Listen, I mean, if you have such a large decline in equities, you definitely are reminded of the worst of times in equities, no? But I would say that the type of VIX spike, the type of kind of capitulation metrics we are tracking is not really at the kind of crisis levels where you could say that we have complete capitulation. And I think our risk appetite indicator as well, which kind of tracks how bullish or bearish investors are across assets, I think that was roughly neutral going into this and has shifted negative, but it's far from these kind of bombed out levels where we would really say that market functioning and capitulation is incredibly extreme. So I think I wouldn't necessarily say that what we've seen yesterday now creates a huge asymmetry where we can say that markets cannot fall from here, because that's clearly always what people are hoping for, that you now have seen that capitulation and you can move on. I think until the fundamental picture improves, you're likely to still stay in a bit of a volatile period.
Yeah. How much do you worry about liquidity?
Listen, I mean, we look at a few metrics, like the top of book depth in the futures markets has been pretty low year to date. And I think generally, like, if you look at kind of liquidity metrics in fixed income space, I think all of them have been a bit lower. But that also reflects the uncertainty and the volatility. So I think, like, liquidity to some extent exacerbates fundamental moves, but it doesn't create always necessarily like new fundamentals, if that makes sense. So my sense is, yes, the liquidity might exacerbate moves right now, but I think it's not that unusual to see lower liquidity if you have so much uncertainty currently. I mean, you have to consider rates volatility in the swaptions market is priced to all-time highs in the front end nearly. I think you're dealing with a lot of uncertainty, so I'm not surprised that market makers are kind of a bit more cautious.
Christian, how do you see the interest rate hikes actually evolving? First of all, why would the Fed take the chance of disappointing or not going for 75 basis points this week, given it's already priced in?
Yeah, it was a weird kind of communication timeline, but I think our economists now think that with the kind of newspaper articles you had yesterday, that the highest probability is that you do get that 75 basis point hike at the next meeting and another 75 basis point hike after that. And I agree with you. I think the Fed has gone a bit with that shock and awe kind of technique. You had that CPI print, you had the University of Michigan inflation expectations as the likely trigger. So I think, obviously the market reaction has been aggressive. And the question now is if that changes the Fed's outlook for kind of the effectiveness of what they're trying or what they have to do. But at the margin, you could argue that it's not been that extreme in terms of like the broader picture, the tightening of financial conditions.
All right, Christian, thanks so much. Christian Muller-Gleesman, Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation, stays with us. We'll talk about European bonds. We'll also talk about currencies around the world. Coming up, the Bank of Japan has accelerated its planned bond purchase operations and included longer maturities where yields are steepening amid a global debt round. We have more on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of Japan accelerated its planned bond purchase operations and included longer maturities where yields are steepening amid a global debt round. The central bank bought 2.2 trillion yen worth of government notes through its fixed rate operation. Now, for more on all of this, we're joined by Bloomberg's senior Asia economy reporter, Michelle Jamrisco. Michelle, thank you for joining us. So, first of all, what makes the BOJ's decision so complicated?
Well, Francine, this is Japan is one of the countries that we've been looking at as one of the big ones alongside China that's just going against the grain right now. Is increasingly complicated in terms of their central bank decision. Of course, as you mentioned, they announced this afternoon the scheduled operation they boosted on 5 to 10 year debt purchases, as well as that unscheduled operation on longer term maturities. What we're seeing now is investors, perhaps seeing this as a modicum of stability in an already wild week, but something that's increasingly seen as untenable, especially in the longer end. I mean, what we're seeing here in a world where, the Fed is poised to perhaps surprise the hawkish side, it's only going to put Japan further out in the cold. But it's increasingly complicated. I mean, we look at the history here, of course, of decades-long deflation, secular deflation. Of course, the BOJ is going to want to see a little bit of inflation here and there, but increasingly untenable path with the way the consumers and businesses are responding right now. They can't all be the perspective that your neighbors have right now in terms of having seen the worst inflation behind us.
Yeah, it's pretty incredible. I know it keeps you busy. The BOJ holding, of course, it's a widening policy gap that's eroding yen. Michelle, thank you. Michelle Jamrisco there joining us from Japan. Now, still with us is Christian Muller-Gleesman, Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation. Christian, the currencies at the moment are extremely volatile. So is it like catching a falling knife?
Well, we know the only currency that has really decoupled as a bit of a safe haven and has essentially a central bank behind it that is fighting inflation in a somewhat credible way has been the dollar. And I think we have to acknowledge the type of increase in real yields yesterday in the US has been remarkable. The TIPS yield has kind of moved now to 60, 70 basis points. I think on a global basis, there's no other kind of longer dated bond that offers you that type of real yield, at least in developed markets. So it feels to me that the dollar has been the key safe haven, and it's very tough for any other FX to stabilize against that right now.
Christian, where do you see the market, how do you see the market pricing in the risk of a recession? So is it something that they're completely discounting when it comes to U.S. markets right now?
Yeah, it's always difficult to disentangle the pricing, especially right now, because if you look at equity drawdowns, they're both reflecting, as I mentioned earlier, a bit of a valuation derating because of this higher inflation volatility, this higher inflation level. But then at the same time, they're discounting a bit of recession risk. So it's not so easy to necessarily extract the pricing. We're looking at the yield curve, of course, which has inverted again. So that sends you a signal that recession risk pricing has picked up. We're looking at cyclicals versus defenses within equities. They have been pricing a bit of an elevated probability of a recession or a sharp growth slowdown. And of course, what we are starting to see is that credit and the VIX as metrics have started to kind of discount higher recession risk again. So I think we're moving closer again to the recession scare, which we've had a few weeks ago in terms of the pricing. I don't think we're past that yet in the sense that markets are pricing more recession risk than a few weeks ago, but we're getting there. I think markets are definitely getting more nervous maybe than when we were last having a recession scare.
So, Christian, what's the terminal rate for actually interest rate hikes in the U.S.?
Listen, I think our economists have been at 3.5, and I think with that they are now below or where market pricing is shifting to, which is closer to 4. And they've been writing that yesterday as well. They feel like now we're getting to a point where market pricing is actually moving beyond what is needed to slow down the economy. So to your point, I think you should probably be worried a bit more about recession risk compared to a month or so ago. I think at least our economists would be based on that statement.
What do you do with some of the periphery bonds? So we saw, a pretty big move. I guess you call it a big test when it comes to Italian BTPs trying to, I guess the market wants to know the ECB's resolve in dealing with fragmentation.
That's right. I think like the big difference you kind of have right now is that the ECB has already said that they're planning to introduce a sovereign backstop to deal with fragmentation risks, but we don't have the details. And without the details, the market needs to price some type of probability of something with that backstop going wrong, the backstop having some conditionality, having something attached to it that might not be as market friendly. So I think that means that the volatility of BTP spreads is likely to remain a bit high until we have those details. Having said that, one has to say, compared to previous stress episodes in euro area sovereigns, it's pretty limited, the stress. And you also have to look at the spillovers. If you look at banks, I think, of course, in aggregate, they've done very poorly, and there's a bigger concern on banks, loan loss provisions, etc., with regards to recession risk as well, not just sovereign risk. But what's really interesting is Italian banks, for example, have not necessarily underperformed euro area banks a lot. So it doesn't seem to be only related to Italy and sovereign risk that you've seen that sell-off in banks.
So, Christian, is there anything that you would buy either in the equity space or elsewhere in Europe right now?
Yeah, I mean, to me, as I said earlier, in the asset allocation, we're currently overweight commodities, overweight cash, and in the kind of risky asset space, we would really focus on real assets and shorter duration assets. I think in Europe, that means to me a big opportunity in infrastructure. I think there's a lot of interesting infrastructure equity that have proven to be quite defensive year to date in what we're dealing with. Because if you think about it, a real asset doesn't necessarily have to derate on the valuation if you have higher inflation risk, because the cash flows are real. So the valuations are less at risk if you own an infrastructure stock. And we've seen that year to date, they're really decoupled and generally focused on these areas, high dividend yield stocks, a bit more quality, which is short duration, a bit less exposed to recession risk. That's kind of where we would look at in Europe right now.
Well, Christian, as always, thank you so much for joining us. Christian Muller-Gleesman, Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation. Now let's get straight to your Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. 2 giant Wall Street banks are said to be withdrawing from handling trades of Russian debt. That's in response to the Biden administration's surprise announcement last week that it's banning U.S. investors from scooping up such assets. Bloomberg has learned that JP Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debts with interested buyers this month. The U.S. Treasury's Office of Foreign Assets Control has said investors in the U.S. aren't allowed to acquire them. Sources tell us a joint venture between Paramount Global and Reliance Industries has snatched online streaming rights to the Indian Premier League cricket. The result is a blow to Disney's streaming ambitions, with the sports seen as a big contributor to global growth. After a bidding war, Disney did secure broadcast rights for TV. Each deal is said to be worth up to $3 billion, according to media reports. And the biggest operator of London's commuter trains and iconic double-decker buses has accepted a £648 million takeover bid from an investor group backed by Australian rival Kinetic. Shareholders of Go Ahead will receive a total of 1,500 pence per share in cash. That represents a 24% premium to Go Ahead's closing price on Friday. A pause in withdrawals from crypto lender Celsius is sending fresh shockwaves across the digital asset market. The key player in decentralized finance halted withdrawals, swaps, and transfers after weeks of speculation over its ability to deliver yields as high as 17%. Cryptos are still reeling after the recent implosion of the Terra stablecoin. And that's your Bloomberg Business Flash. Francine?
Angel, thank you so much. Angel Feliciano there in London with me. Now, coming up, Digital Dive, we take a closer look at the crypto sell-off triggered by that surprise inflation reading, which hit a 40-year high. We also look at Italian yields. The biggest concern out there is, of course, this lack of clarity on how the European Central Bank will deal with rising borrowing costs. Amongst the region's riskiest debt, of course, has sent, for example, Italy's benchmark yield rising a shade above 4% for the first time since January 2014. Now it's just below that price point. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the value of the global crypto market has slipped below $1 trillion. Bitcoin dropped to an 18-month low, and the NFT index saw a 23% decline. Popular NFT collections have been hit hard as inflation proves to be even trickier opponent to beat than expected. Now, let's get straight to our crypto reporter, Emily Nicole in Zurich. Emily, you're an expert in this. So what's going on in crypto right now?
So as you mentioned, we've definitely seen a large market rout over the last day or two. Crypto prices have been plummeting. Bitcoin fell as low as 20,000 earlier today, but it's also stabilized somewhat. It pared back those gains this morning too. And it's not just Bitcoin as usual, it's all of the assets all going at once. So Ethereum is also falling. Some of the altcoins were struggling too, and you mentioned NFTs. So we're definitely feeling the pain for investors across the board right now.
So how is this different to the crashes we've seen in the last couple of months?
So what we saw last month was a crypto crash that was sustained by the collapse of a project called Terra. That was a stablecoin project that was upheld as one of the biggest experiments in decentralized finance, and that came tumbling down. And this month, the thing that we think is triggering it is not just the overall concerns that every investor is feeling in parts of traditional finance about interest rates and things going on with the Federal Reserve, but also some impact from stuff happening in crypto too. Over the weekend, there is a project called Celsius that uses a staked version of Ethereum to prop up its activities, and that suspended withdrawals for investors, which sent some panic spirals going through traders because, if you think about what would be the early warning signs for the previous collapse, that's kind of what they think they're seeing here, and that definitely caused some contagion across crypto assets.
So is there an end in sight for this? How should we look at what could happen next?
So if we look ahead to what we think might be coming for crypto prices in the next few days, there's some element of stability returning this morning, but it's definitely extremely volatile, and we're not too sure, where the market pain will end. However, what we are looking for, at least from that crypto project I mentioned, Celsius, is a little bit of confidence from them as to whether or not they might be able to restart activity, and also looking ahead to this broader thing that's happening within crypto called the merge. It's an upgrade for the Ethereum network. That's sort of what's compounding the problems for Celsius at the moment. And if we see any signals that that upgrade is going well, that might also help boost investor confidence in the market.
Emily, thanks so much. Emily Nicole there from Bloomberg Crypto. Now, let's also go back to the markets. We did start the day on a higher note when it comes to European stocks. A lot of that enthusiasm or that stability starting to fade away. If you look at U.S. equity futures, they did rebound. Treasury still snapping a 4-day sell-off after this market rout driven by expectations of sharper Federal Reserve interest rate hikes to fight inflation, but the opening bounce in the Europe Stock 600 then quickly faded. In fact, I'm looking at the gauge, it's hovering around a one-year low, suggesting that concerns about aggressive monetary tightening have not completely eased off. And bond yields also in most of Europe were steady. Gilts gained after data showed in the UK that spending power of households plunged as inflation eroded wage increases. Bloomberg Surveillance Early Edition continues in the next hour with Matt, Kailey, and Anna. This is Bloomberg.
This week is fraught with peril.
Despite all of these leading indicators, we have not seen the central banks blink.
The Fed doesn't have much reason at this point to slow the pace of rate hikes.
If they're going to do 75, it's better to do it sooner than later.
We can start to sort of look for areas of the market now that have been de-risked.
The markets are performing incredibly well. There's a ton of liquidity in the market. There's a lot of transparency in the market.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, June 14th. Our top stories today. European stocks and US futures breathing a little easier following yesterday's mayhem. Investors seeing a pocket of calm after the S&P 500 plunged into bear market territory. Did markets say 100? Markets start pricing in even more dramatic hikes by the Fed. JP Morgan sees 75 basis points, but describes a full point hike as a non-trivial risk. And the crypto chaos shows no sign of letting up. The market sank below $1 trillion. Bitcoin continues its descent, while the fortunes of crypto billionaires are vanishing as quickly as they were made. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, the conversation continues over just how big the hike from the Fed is going to be then tomorrow. That feels like the big question hanging over the markets. And in that context, you have to wonder how soon will the turbulence return?
Yeah, have we seen a bottom yet, Anna? Is that what we saw yesterday, full capitulation, or does this sell-off have further to go? These are all questions that we're still looking for answers to. Of course, it wasn't just U.S. stocks that fell into a bear market yesterday. It was global equities, and you saw a little bit of that continuing in Asia overnight. Though Asian equities were able to close off of session lows, you still had the MSCI Asia Pacific Index down by nearly a full percentage point. And of course, it hasn't just been equities selling off as we reassess not just Fed expectations, but global central bank expectations. We have seen massive selling pressure in bond markets around the world, and that definitely continued in a massive way in Australia overnight, where the 5-year yield was up 31.5 basis points. 3.665% is where we trade at the moment. That is the highest going back a decade to March of 2012. You also are seeing the Japanese JGB yield falling below 25 basis points because the Bank of Japan is maintaining yield curve control, buying more bonds, keeping policy easy, trying to maintain that upper bound, no matter what the cost is, apparently, of the Japanese yen, because the Japanese yen, right around those 1998 week levels against the dollar, Matt, we're trading right around 134.21.
Yeah, it continues to be a fascinating story out of Japan. Here in the U.S., we officially entered a bear market. Yesterday, we're down 21.3% year to date. Right now, you see futures bouncing a bit after that big move down. Really, three big 2% plus, 3% plus down days in a row. So maybe we get a little bit of a recovery today. We also look like we're going to see a little bit of a recovery. We are seeing a little bit of a recovery in yields. We were up to 337 at the highest level, and that is a record, the most since 2011. Right now, we're back down to 330, still at 2011 highs. NYMEX crude up just about 88 cents right now, 121.80 barrel. Remember yesterday we started the session off with crude down on COVID lockdown concerns out of China, and then it turned around and rose today at the end of the day, really exacerbating the market pain. Bitcoin, speaking of market pain, it dropped yesterday to 21,000. Right now it's at 22,617, but getting very close, as Eddie Vanderwalt points out, and we're going to talk to him a little bit later, to the highs that it reached during the last halving. And if it falls below those highs, it's going to be something new for Bitcoin. Okay, it's only 10 years old, but very interesting stuff, and we'll talk to Eddie about that later. Anna?
Yeah, more from Eddie on that subject later on. Let's get to the European equity markets, and this is the picture we have for you right now then. European equity markets fairly flat, a little bit of respite, a little bit of digesting, really, what's happened over the last 24 hours or so. Such has been the pace of the rethinking of expectations of hikes from the Fed and, to some extent, other central banks around the world. So we got a pretty mixed picture. Mixed, flat, slightly negative, actually, increasingly so, perhaps. The CAC Cameron down 0.5% now. The DAX down 0.1%. We just got the ZEW investor sentiment data out from Germany. It was in negative territory. Didn't seem as if it was so much of a game-changing number, but we'll keep an eye on that, of course, given sentiment as fragile as it is, perhaps. We do see some gains in some sectors today, though, and energy stocks, to Matt's point about a higher energy and oil, a higher oil price, that's a sector that's benefiting. We also see banks rebounding a little bit from the lows of yesterday. So just as we saw Italian banks beaten up by concerns around fragmentation. Some of those Italian names gaining today and were up by 1.4%. That's also in focus as we look at what's going on with euro dollar. Interesting that the euro seems to have detached itself from the global interest rate narrative over the past few days. Post the ECB, there was a lot of talk about ECB rate hikes, of course, to come, and more hawkish policy and what that would do to the periphery of Europe. But that seemed to weigh, that peripheral fear seemed to weigh on the euro rather than expectations of tighter policy support the euro. And today we see a little bit of a rebound from those recent lows, and certainly a rebound from the strong dollar that we saw in yesterday's session. Italian two-year yields a little bit calmer than they were yesterday. We still see action in the two-year part of the curve, of course, and we still see a lot of focus on this. We're going to hear from Isabel Schnabel of the ECB a little bit later on. What will she have to say about fragmentation risk? And Atos, this is a French tech business. I put this in here. They're talking today about restructuring of the business, and they've announced that the CEO is going to depart. That comes as a surprise to investors, and the stock was down a lot more than this, now down by 16%, Kailey.
Yeah, still a massive move. We'll continue to pay attention to that throughout the day, Anna. As for what else is ahead on this Tuesday, Biden is traveling to Philadelphia, Pennsylvania to deliver remarks at the 29th AFL-CIO Quadrennial Convention. He's going to be talking about the power of the American worker. Then in terms of politics, U.S. primaries are held in Maine, Nevada, North Dakota, and South Carolina today. And then on the economic data front, we'll be getting U.S. PPI data at 8:30 a.m. New York time. And several economists, Matt, say this is the one to pay attention to. It may be even more important than last week's CPI.
All right, we'll be paying very close attention to that. Actually, Neil Dutta wrote a note about that, and we'll talk about it a little bit later. Right now, pockets of Wall Street are raising the possibility that the Fed could consider the biggest interest rate increase since 1994 when it meets this week, with some predicting a 100 basis point hike, including Wharton School finance professor Jeremy Siegel. He spoke on Bloomberg yesterday.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
Siegel also spent some time running the shadow Fed. Now, economists at major Wall Street firms have been quick to change their calls. Kriti Gupta, Bloomberg Markets correspondent, joins us now to tell us about, everybody's seemingly trying to go higher and higher.
Everybody. I mean, remember, we've been here before where the market is getting ahead of the Federal Reserve to some extent. The fear here is that that's going to happen again. Take a look. In just the last 24 hours, you had JP Morgan, Goldman Sachs, Evercore all come out and say 75 basis points is their new base case scenario. Of course, this following a report from the Wall Street Journal saying that this actually could very actively be considered in the meeting. And of course, we know Nomura and Barclays and Jefferies had already made that call for 75 basis points as well. But what's important here is the read-through, because we know the market has already been pricing it aggressively since Friday, a CPI report that was extremely high, consumer sentiment at record lows once again. But the read-through here is recession risk. At the end of the day, can the economy really digest a 75 basis point hike? And that's really going to be the concern. Look into the markets beyond Fed swap spreads, and you're actually seeing that the Treasury curves, the 2s, 10s, the 5s, 30s, the ones that we like to look for recession risk, well, it's flashing that signal once again. It tells you there is worries actively in the market. Can the economy actually digest this?
Well, you mentioned that JP Morgan, Michael Feroli, is one of those calling for 75 basis points tomorrow, but he said the risk is non-trivial that they actually move 100 basis points, which would be in line with Professor Siegel. Interestingly, though, and a strategist over at JP Morgan, very closely followed, pretty much always bullish, Marko Kolanovic, was out saying that we think it's going to move 50 basis points, and he basically went on to say that the rates market has overdone this pricing, that the Fed is going to surprise devishly. And, well, maybe that is true as well. He says that the Fed will surprise devishly relative to what is now priced into the curve. So, Kriti, if the market has overdone this, and given the moves yesterday, not just in the bond market, but in the equity market as well, where only 5 stocks in the S&P 500 are positive yesterday, have we seen capitulation? Was that the big washout, cathartic puke, as some call it, and now we're done?
Well, cathartic puke, that's quite the statement. This is interesting when you talk about the different ways this could play out, because the assumption here, the consensus is that if you do get a 75 basis point hike or 100, as it is starting to seep into the conversation, is that would basically be the straw that breaks the camel's back. That that would be your signal of capitulation. But there is an argument in the market that you'll see the opposite, that there'll be a sigh of relief in the market, and off the back of, say, 75 basis points or 100 front-loaded, basically all the pain goes out in one go. And essentially, I think there's a phrase, a Mary Poppins phrase, a spoonful of sugar helps the medicine go down. Something similar to that.
Anna knows it well. Anna?
That is correct, Chrissy. Yes, I can confirm the correctness of that statement. Thanks very much, Bloomberg's Chrissy Gupta, on whether we've seen capitulation in these markets. Have we seen any capitulation on Bitcoin? Let's talk about crypto. Bitcoin delivered another white-knuckle ride Tuesday, dropping 10% before pairing much of that slide, still down 2% and change. That's as speculators struggle to price in the prospect of even bigger Fed hikes. Eddie van der Veld of our Bloomberg Markets Live team has been following the action and is with me. I mean, it's a wild ride, isn't it? Tin hat kind of stuff, I suppose. Some people might call it. 22,000 is the handle on Bitcoin now. Eddie, where have we got to on this, and how much further does it fall?
Yeah, absolutely. I think, the real capitulation here started with that CPI reading, which just shows us that Bitcoin at the moment is very much a risk-on asset and is liquidity-driven. And as the liquidity drains out of the market, the headwinds for crypto keep growing.
Hey, Eddie, thanks so much for joining us. We're going to be talking about this, obviously, all day long, and I'm going to be using your chart as well later on. Bloomberg Crypto. That's at 1 p.m. New York time, 6 p.m. London. For more on the crypto chaos, Kailey and I do it every week. We'll speak today to an investor who's been sounding the alarm on Celsius, as well as one of the first Wall Street crypto analysts, Nick Carter, of course, now of Castle Island Ventures. Let's get back to the BOJ ramping up the defense of its policy framework after yields came under renewed pressure, upward pressure. Our chief Asia economics correspondent, Enda Curran, has the latest on the Bank of Japan. Enda?
A very aggressive intervention in the bond market today, Matt. It was on schedule. They came in to buy 5- and 10-year dated bonds. And what this underscores is how committed Japan's central bank is to supporting its economy, to keeping bond yields low. Now, that's a very stark divergence from where the Fed is at, for example. And even though inflation in Japan is increasing, the authorities there are pinning much of that on the imported cost of oil rather than underground strong demand. We do have the Bank of Japan meeting this week. We might get more detail on where they will bring that policy. Some economists say they may tweak that yield curve control strategy that they have. But today, at least, they came into the bond market in a big way, signaling that, unlike its peers, the BOJ remains committed to supporting its economy.
Yes, and so a lot of people in the market's asking how long that divergence between the BOJ and others can continue. How long can they continue to withstand the pressure of rising rates? Now, let's switch to what's going on in Hong Kong. And Carrie Lam, the outgoing Hong Kong chief executive, speaking with Bloomberg just a few moments ago. Let's take a listen to what she said.
Despite some skepticism and cynicism about Hong Kong's future, I remain very optimistic and confident of Hong Kong's future. And one of the reasons for my confidence and optimism is Hong Kong's unique strengths under one country, two systems.
Carrie Lam there. She's optimistic about Hong Kong's future. She does acknowledge, though, that the weight that has been applied to Hong Kong by the way that COVID has been handled in China and Greater China. What do we know about the Hong Kong economy and how it's withstanding the latest from COVID?
Well, Carrie Lam will finish as chief executive in a few weeks. Her message on the way out the door has been that COVID-0 is now damaging Hong Kong's status globally as an international finance hub. And there are big expectations here, Anna, that the incoming government after July 1 will change things up and perhaps ease the quarantine at the airport. In particular, lobby groups are out every day of the week making this point that the economy does need to be reopened. Now, what I would say is, while Carrie Lam made those points about being optimistic for Hong Kong today, at the same time, her government were reintroducing new restrictions on entering bars that come into effect tomorrow night, requiring a rat test to be negative before you go into the bar. So there's still a long way to go before Hong Kong is fully reopened.
All right, Bloomberg's Enda Curran in Hong Kong. Thank you so much. And we'll have more from that interview with Carrie Lam throughout the day here on Bloomberg Television. Meanwhile, President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman. That's according to an NBC report. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now with more from D.C. So, Anne-Marie, the White House said yesterday that a trip is in the works. Nothing is final yet. They also said this isn't just about oil. Is it really just about oil?
It's not. On one hand, it is in the sense that obviously the war in Ukraine, Russia's invasion of Ukraine, that has started to shift the tides in a number of capitals around the world about making sure they shore up their allies. And it changed a lot of diplomatic priorities. And that's obvious for this administration, which the president campaigned on making Saudi Arabia a pariah, now is going to be engaging not just with the kingdom, but if he's going to go to Saudi Arabia, he's obviously going to be engaging with the de facto leader, and that's the Crown Prince, Mohammed bin Salman. When it comes to the oil market, you did see a bit of an olive branch in that last OPEC Plus meeting, but I think people sometimes lose track of where we are right now in the oil market. Saudi Arabia and the UAE, yes, are the two countries that have spare capacity, but they don't have spare capacity to solve $5 a gallon gasoline. That's also only one part of the problem. When you look at the relationship, it'll likely be focused, obviously, on energy, but also strategically, regional issues, defense issues in the region, and as well as economic issues. So if the president does go there, he'll be meeting with not just Saudi officials, but also others, part of the Gulf cooperation, and there'll be a number of issues on the agenda.
All right, Bloomberg's Anne-Marie Hordern in Washington for us. Thank you so much. Now let's get back to the markets and take a look at some of the stocks moving in pre-market trading here in the U.S. A big outperformer is Oracle. It reported earnings after the bell yesterday. Revenue topped estimates thanks to strength in the cloud and the database business. As a result, that stock is up nearly 13% before the bell. Another stock moving higher is Twitter. We got news overnight that Elon Musk is going to meet with Twitter employees at an all-company-wide meeting on Thursday, the first time he'll have addressed them directly since that $44 billion deal. Remember the price tag on that deal? $54.20 a share. Twitter's trading fractionally higher at $37.32 this morning. One other stock I wanted to check on is MicroStrategy. This, of course, is essentially a Bitcoin proxy because Michael Saylor, the company's CEO, is a huge Bitcoin evangelist. The company holds a lot of Bitcoin on its balance sheet. There is now concern about potential margin call because of how much Bitcoin has dropped. The stock was down 25% yesterday. Due to that, it's down another 1% before the bell this morning, Anna.
Yeah, the read across from crypto then it continues. Coming up, Kailey, we will talk to Art Hogan, Chief Market Strategist at National Securities. I spoke to people from the MLive blog earlier, and they were saying that the Fed will do as much hiking as the market will let it get away with. How much is that? We'll ask Art for his perspective. We'll also speak to Dominique Dwor-Frecaut, somebody with experience of working at the Fed, now at Macro Strategist at Macro Hive. We'll get her take on how the Fed operates in this environment. Plus, breaking the bank or the law, how the post-Roe reality is playing out in Texas. Read more by typing NI Big Take into your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and on Bloomberg Television. I'm Matt Miller with Kailey Leinz in New York, Anna Edwards with us out of London. Now, joining us is Bloomberg MLive's Tatiana Daria to talk about what we saw yesterday in terms of yields and the sell-off. And all of this is very interesting, especially when put into context, Tatiana, of inflation. You're writing about that on the MLive blog today. We have rarely seen such a big gap between the core and the headline numbers, which, when you think about it, makes a lot of sense because if you're spending all of your money on food and gas, you don't have enough for the other stuff. No more demand for the iPads, bicycles, and T-shirts or whatever. And as a result, those prices drop.
Exactly that, and that hurts profits and therefore hurts stocks. And like you mentioned, if we look back historically, there have been just 5 occasions when we saw that gap really widen past the 2 percentage points. We're at 2.6 percentage point right now, the largest since 2008. And that has tended to occur around recessions, and that is never a good thing for stocks, obviously. But the other common thing about them is that those were the times that we saw energy prices skyrocket, 1973, 1980. Those were the oil shocks. 2008, obviously, we had bigger issues going on with the housing crisis, but oil also jumped to $146 or so. So that's also been a case where high energy has fed through those inflation problems.
Well, and obviously, because of the inflation problem, this is a market that has dramatically repriced its expectations for Federal Reserve hikes. We saw that reflected in the Treasury market yesterday with huge moves in yields. What are you seeing in credit?
Oh, well, it's been interesting. I think we've seen credit measures jumping, credit risk measure jumping. Basically, investors are just jumping in on protection. The credit market can be a little illiquid in times like that, so investors flee to CDS because those are easier to trade. But I think this is a corner of the market that can be very vulnerable in this tightening cycle, just because there has been so much erosion in investor protection over the years. When times are good, easy monetary policy, investors just piled onto a lot of debt without asking too many questions or reading all the footnotes there. So there's, a huge pile of debt from zombie companies. These are about a fifth of the largest 3,000 companies in the U.S. Wow. And those companies are just hanging by a thread. Their lives have just become a lot more difficult because their access to the market is becoming harder. We have only seen one CCC bond just being brave enough to access the market, and I think we're still waiting on details because that sale is just in question right now.
Tatiana, thanks very much. Tatiana Dario joining us there with an update on the markets. For more market analysis, check out MLIV Go, the Markets Live blog on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. European stocks and US futures breathing a little easier following yesterday's mayhem. Investors seeing a pocket of calm after the S&P 500 plunged into bear market territory. Did anybody say 100? Markets start pricing in even more dramatic hikes by the Fed. JP Morgan sees 75 basis points, but describes a full 1 percentage point hike as a non-trivial risk. And the crypto chaos shows no sign of letting up. The market sank below $1 trillion. Bitcoin continues its descent, while the fortunes of crypto billionaires are vanishing as quickly as they were made. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, an entirely non-scientific poll of a couple of guests I spoke to in the early hours here in European programming saying this isn't capitulation. It doesn't feel quite scary enough. Yes, they were big losses yesterday for risk assets, but there's a driver, and for some at least, it felt orderly. We'll certainly get into this conversation in the next half hour of programming.
Yeah, absolutely. We'll be talking about that throughout, I think, the day for sure. Right now, let's take a look at what's going on in terms of futures preparing for the open. We are seeing a bit of a bounce after the big drops that we saw yesterday, the big drops that we saw on Friday. So futures up about 0.5%. And we also see yields coming back in. The 10-year yield got up to 337. Still, we're at 2011 levels at 331.61 on the 10-year, and that could be doing a little bit of tightening for the Fed. Speaking of, NYMEX crude continues to rise, 121.50 for a barrel of Texas Intermediate. I thought it was very interesting to watch this turn around yesterday. We were down in the morning and then came up sort of adding fuel to the fire, so to speak. No pun was actually intended, but that's pretty good. And then Bitcoin right now, 22,402. Remember, we've been watching this 30,000 level for weeks and weeks. Yesterday, it all came crashing down. Celsius stopping withdrawals, I should say pausing, they say withdrawals, definitely adding fuel to the fire there. But it'll be interesting to see what happens with the entire crypto space after such huge drops. Kailey, what do you see in terms of the pre-market movers?
Well, I'm really paying attention to large cap technology, Matt, because as we know, the equity market literally cannot hang in there really when these stocks are down because they are such a large weighting within it. When you look at the likes of Apple, of Alphabet, of Amazon, of Tesla, they together along with Microsoft comprise something like 20% of the S&P 500. So when all of those stocks were down hard yesterday, that of course created a large drag on the broader markets. But as we see futures higher this morning, you are seeing these stocks also rebounding a touch. You have Apple, for example, up about 1 percentage point in pre-market trading after being down 3.5% yesterday. For Alphabet and Amazon, they were down about 4% and 5% respectively in the Monday session. They're each higher by 1% as well. And then Tesla is up 1.3%. It was the biggest decliner of those on the board here yesterday. It was down about 7 percentage points. And Anna, on a year-to-date basis, Tesla is down 39%. It has been absolutely brutal for these high multiple companies in particular as they face down the specter of higher rates. Of course, that monster move in treasury yields weighing on growth more broadly yesterday.
Yeah, absolutely. And that still seems to be the driving force behind US tech, doesn't it? We heard from Oracle, of course, a positive update there. But whether one company's statements and earnings can, I mean, it feels so retro, really, to be talking about earnings when there are such big macro themes in play right now. And that seems to be what's driving markets. Here, driving markets in Europe this morning, we're fading. We're fading as we go towards the lunchtime part of our day here in Europe. So mid-morning, I should say, not getting ahead of myself. Stocks Europe 600, then down by 0.5%. We were actually in positive territory at the start of... I get up early. We were in positive territory at the start of the European trading day, but we didn't manage to cling to that, and we see European stocks fading as we go through the day. Energy stocks getting a bit of a boost, bank stocks getting a bit of a boost as we price back in some moves higher after yesterday's selling. Certainly some Italian banks were beaten up yesterday, and some of those rebounding. The euro's interesting. We've seen a bit of a disconnect between what the euro is doing and interest rate differentials. It seems that in lots of parts of FX, thinking about the yen here, interest rate differentials are in the driving seat. But when it comes to the euro, it's fear around growth and fear about around fragmentation, as we now seem to call it, or potential for disorderly moves within the eurozone, potentially even break up within the eurozone. All of that seems to be front and centre, rather than what's been going on with interest rates and factoring in higher interest rates from the ECB. The euro, though, bouncing back from some of those losses of yesterday. The Italian two-year yield just completing the picture on what was a really turbulent time yesterday. This is where we yield right now on the two-year, 2.08. That's been moving fast, Matt.
All right, very interesting stuff. Right now, I want to talk about what we expect from the Fed in light of this inflation. Of course, that's really the cause of all of this market turmoil. Joining us to do that is Dominique Dwor-Frecaut, macro strategist at Macro Hive. Dominique, let me start with something that Jeremy Siegel suggested yesterday. I thought very interesting. The professor from Wharton saying if the Fed comes out with a 100 basis point hike, not only does that affect inflation, but also changes the narrative, puts Powell in control of the situation, and maybe markets would react positively to that. What are you thinking? Is it possible?
So, first of all, it's not very likely. The Fed has done what the Fed does when it wants to talk to market during the pre-meeting blackout. It's reached out to trusted reporters, and it's 75 basis points. It's not 100. Then the other things that I think market participants have not focused enough on is that there's going to be a big change to the SCP. That's, some of the newspaper articles were about that the Fed, the administration made a mistake. They need to go for a much more ambitious hiking cycle. And I think the SCP is going to show unemployment above the long-term unemployment level. So basically, we're going to have a SCP that tells us more or less the Fed has given up on hopes of a soft landing. And that, I think, should scare markets quite a bit.
Yeah, so we will all definitely pay attention to that summary of economic projections, Dominique. So you say it's 75 that the Fed is realistically considering, because essentially that is what the market has given the Fed, to some extent, the permission to do. Do you think that the market would be happier to see a more hawkish Fed, in that it would mean that the Fed is actually going to do what it takes to get inflation under control? Powell would be more Volcker-esque, and if they're perceived as too dovish, that actually is a bad thing because it would mean inflation runs hotter for longer?
So the market would love the Fed to be able to promise that it can tame inflation without a recession. So 100 basis point, 150 basis point, no problem. The market would be very happy as long as unemployment would stay below 4% and growth would remain above trend. That would be fantastic. We would get an extraordinary rally. But unfortunately, and again, looking at this Wall Street Journal article, it looks like what we are going to get is probably an increase in the long-term rates of unemployment, and in the intervening period, the unemployment rate climbing above the long-term unemployment rate. So, what kind of growth figure the Fed is going to put on that, I'm not sure. Maybe they will still show growth positive, but certainly they will have to show it below trend, below 2%. So if
okay, Dominique, Sorry, just to sorry to interrupt there. Just to reiterate then, so you think the Fed is going to start forecasting, expecting a long-term increase in unemployment, and therefore, I suppose, giving us a sense of how far they are prepared to let unemployment rise so that they can tackle inflation?
Exactly. And you see, the Fed has a problem. It's the first time that they have to raise rates to tame inflation. I mean, in the previous two hiking cycle, it was more about normalization. There was no inflation issue. But they have to do it with SCP. So they have to tell the market what the impact of raising rates is going to be a few years down the road. And it's becoming, clearer and clearer that, first of all, we have a wage price spiral. Wages are going up due to higher prices, which makes sense with the low unemployment we have. So the only way to bring down wages and inflation is to have unemployment go above the long-term estimate. And I think that's what this Wall Street Journal article is telling us and what we are going to find out when we see the SCP tomorrow.
Dominique, thank you so much for your time. We appreciate it. Dominique Dwor-Frecaut of Macro Hive, thanks for joining us to think about where the Fed goes. We continue to put the Fed in the spotlight. We'll talk next to Art Hogan, Chief Market Strategist at National Securities. What is he expecting from the Fed? And crucially, how will markets respond? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Avenue Capital Management CEO Mark Lazary. That's at 3:30 p.m. in New York, 8:30 p.m. in London. This is Bloomberg.
This week is fraught with peril.
Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
because I still think we've got some wood to chop with respect to the macro and policy outlook.
Some of our top guests weighing in on the markets, Fed policy, and buying opportunities. Is there a dip buying opportunity in this market after the S&P 500 fell into a bear market yesterday? Let's ask Art Hogan, Chief Market Strategist at National Securities, who's joining us now up early for us. So, Art, for this to be a buyable dip, in theory, that would have had to be capitulation. That would have had to be the big washout that everyone says we needed to see in order for the worst of the sell-off to really be over. Is that what it was?
Well, I can certainly tell you that's what it looks like, right? So when the problem with everyone having their own definition of things like what a bear market means, and I would argue we've been in one for a long time, and what capitulation looks like. And I think when you put too fine characteristics or try to define that too succinctly, you miss opportunities like I think we're seeing this week. I think what we had yesterday was indiscriminate selling. Everything was for sale. Energy finally got around to being for sale. It's down about 10% over the course of the last 2 days. 500 of the S&P 500 were in the red for most of the day. Same was true for 2,000 of the Russell 2000 stocks.
Yeah.
So when you do damaged valuations, this much multiple compression in a short period of time, and then have one of those days like yesterday where everything's for sale and agnostic of sector or vertical, and that's what panic feels like. That's what the end of this cycle looks like, not the beginning.
If that's what yesterday was, if you're making decisions this morning, looking to put money to work, where are those specific opportunities that you see?
Yeah, I think the three best opportunities right now are technology that has earnings, right? So multiple earnings tech, some of the big household names that have seen massive multiple contraction in the near term, and I think that they've got defensible cash flows and moats. I think on the other side of that barbell, I would certainly continue to look at energy stocks. They're down 10% in a short period of time. They will likely have a long runway in front of them over the next 12 to 18 months. And the third is it's okay to be defensive and look at healthcare, and healthcare still trades at very attractive valuations. Those would be our three top picks if you're looking to stick your toe in the water today after the kind of damage we've seen through the course of the last 8 weeks and certainly the last 2 days.
Art, I'm watching certain gauges to see whether or not this market really has capitulated. The VIX is one of those. It seems like it sort of slowly and steadily rose finally to above 30 yesterday, but wasn't in any kind of hurry. Another one is the put-call ratio, which we haven't even gotten to levels that we saw in 2018 or 2019. Right now, I think not even up to 1 yet. So why do you think these gauges and so many others are trailing?
Yeah, it's so interesting, Matt. Those are the two things that people are pointing to the most to say, hey, we're not there yet, especially the VIX. For some reason, there's a magic number above 38 and getting closer to 40 where we believe, okay, that's it. There's enough people that are afraid that that we can get out of the water. And that could well be true. But if everybody's watching this and defining the same points that you're looking at right now, whether it's the put-call ratio or the VIX, perhaps it never happens, and yet we could have a tradable bounce over the course of the next month or so. I just go back to the last Fed meeting, or 2 Fed meetings ago in March, where we sold off, call it 15% coming into that meeting in a pretty straight line from January, February. March rolls around, we had the meeting, we bounced 10%. I think we're setting up for that kind of bounce after this meeting because I think the Fed's going to do something outside of consensus.
Oh, that's interesting. So what do you think the Fed is going to do? We just spoke to our last guest was saying that, look, all of the newspaper and Bloomberg and other outlets carrying stories that say 75 basis points is on the table. That, for her, was enough to say, look, the Fed's going to do 75. So what do you think is going to come from the Fed that's out of consensus?
Yeah, well, unfortunately, we get hung up with the fact that Chair Jay Powell said at his last meeting that 75 wasn't on the table, but neither was an 8.6 CPI. I think now that that's changed, he has the ability to say, listen, this is not flattening out, whether it's the CPI or the PCE. We need to get more aggressive here. I think the Fed funds futures have it right. So one of the next 3 meetings is a 75 basis point hike. It doesn't necessarily have to be tomorrow, but it certainly could be that 75 basis points or more back on the table and gets the market ready for this. So I think it's 50-50 that he goes higher than 50 basis points and certainly will in one of the next 3 meetings. One of the oddball things that he might be able to do too is add a meeting to August. Right now there's no meeting in August. They could actually propose that they're going to, August is going to be another meeting and give them another opportunity to front end load this and get back in front of the curve.
That would be interesting if he adds another meeting because it would break with the structure that he seems to stick to so rigidly, especially wanting to always warn markets ahead of time of any moves in a Burnsian way, right? Is this market waiting for a Volcker-like move?
Well, I think Jay Powell wants to sound as aggressive and deliberate as he possibly can. So I think there's some balance there, Matt. You bring up a really good point. I think he wants to say we're going to do whatever it takes to tame inflation, but we're not going to surprise you, right? And I think that there's a bit of a contradiction in trying to do. Right. Well, I think the surprise would be, hey, at the last press conference, I said 75 is not on the table. Guess what? Now it is on the table. And over the course of the next 3 months, we're adding an additional meeting. I'm not sure that that's startling.
Okay, so surprise guidance instead of a surprise hike, that could be the story. Art, thank you so much for joining us. Art Hogan, Chief Market Strategist at National Securities. Thank you for your time. Coming up on the program, Carrie Lam is optimistic about the future of Hong Kong. We brought you a short clip of our interview with the outgoing Chief Executive of Hong Kong. We'll bring you more of that shortly. This is Bloomberg.
I'm a person who believes in relativity. So everything is relative. When people are opening up and Hong Kong is still imposing a 7-day designated hotel quarantine, that to a certain extent weakens our position as an international city.
Carrie Lam, outgoing Hong Kong chief executive, speaking with Bloomberg a little bit earlier. You can catch more of that interview in the next hour of Surveillance. And for more of what's ahead, let's get to our single best charts. And Tom Keene brings us that, of course, as he does daily. Tom, I saw here in the UK real wages posting their biggest drop in 2 decades. That data out on the Bloomberg just this morning. You've got real wages in focus in the US as well.
Yeah, I saw exactly what you saw, Ann. And I'd also note as we speak, sterling down to 121.25 is going to break down a new sterling weakness here. There'll be an Anna Edwards donation coming up later on Surveillance today. And it is about real wages. It's about inflation-adjusted wages that we're seeing across all the deciles of America. My favorite is the ECI series, which is a combination of wages and those benefits we never take into account. They're very valuable. And the integrand of the pandemic shows the good feeling of wage gains that we saw through the beginning of the pandemic, and we have plunged down like a rock. It is truly stunning to see where we are over 20 years.
Yeah, that is really stunning indeed. And also maybe makes us less worried about a wage price spiral, right? Nonetheless, Tom, before Friday morning, 350s felt big. Then all of a sudden, 75 was the outlier until yesterday. Now 100's the outlier. Who are the guests you're talking about today in preparation for tomorrow's big meeting?
We're going to review this, but I'm going to underplay it. Right now, it's all the rage. You know, Gina Smilik over at the New York Times is writing it up this morning. Our team is writing it up as well. You mentioned Jeremy Siegel, Matt, talking about 100 beeps. To me, it's going to be a set of people around the table at the Eccles building gauging this out. To have Carl Weinberg with us will be very good. He's got decades of perspective on a Fed that wants to maintain control.
All right, very interesting stuff. Carl Weinberg as well as David Rubenstein on with Tom. A Bloomberg Surveillance up next, of course, Lisa and John. I think Kailey in for John today. We're going to be watching a lot of data still today. The PPI, in fact, coming out. Neil Dutta writing on Friday that maybe the PPI is even more important than the CPI because there's so many components that are in the core PCE. Sorry for the alphabet soup, Anna, but basically the Fed is supposed to watch core PCE, or that's supposed to be its preferred gauge. Politically, it's very difficult to ignore headline CPI. But PPI may be important to PCE, and that could be important to the FOMC tomorrow at its meeting.
Okay, you just added more alphabet soup, but I take away your point completely, even though we do, of course, experience headline inflation, a point you've made many times, if we spent, of course, according to the basket. Let me tell you what's coming up here in Europe. We're focused, Matt, on something that might interest you. Isabel Schnabel at the ECB. She's going to be doing a speech later on talking about fragmentation, the risks of fragmentation, or will she? I mean, that's what we're being told she's going to be talking about. But they don't like to talk about it perhaps too much, and this is the big question. How much detail do you give about tools to fight what's called fragmentation? And how much do you hold back until it's actually necessary? And Matt, it's called fragmentation. I think we used to call it breakup risk back in the day.
Yeah, but now the idea is that it could push us the other direction. So fragmentation maybe is a better word? I don't know.
Yeah, maybe. Well, we'll see what Isabel Schnabel has to say on the subject of forging the Eurozone, continuing to forge the Eurozone. What tools does the ECB have if it should need them when it comes to fighting the spreads? That is it for this program. Surveillance is ahead. This is Bloomberg.